So the most popular valuation method for stocks is the price to earnings multiple. Divide the stock price by your 1-year forecast for the earnings of that stock. What are you prepared to pay to access that expected growth? It's one of the most simplistic measures, but also one of the most misused. A company that trades on 10 times PE doesn't make it a better investment than a company trading at 20 times, without considering the drivers of value. Now, the basic construction of valuation multiples rests on whether a company is earning in excess of its cost of capital, i.e. if return on equity is greater than the cost of equity, a company should be trading above its book value. Now, return on equity is a function of growth expectations in the business cycle, the level of investment opportunities for the firm, and the level of tax rates, among other things, while cost of equity is more a function of financial conditions, i.e. the level of interest rates, the inflation backdrop, which will influence monetary policy, credit spreads, which are closely linked to risk appetite, and the market desired level of equity risk premium. So think in basic terms, valuation multiples reflect the balance between growth expectations and financial conditions. But comparing PEs over time must be carefully assessed owing to earnings cyclicality. When we come to the end of a recession and earnings have plummeted, profit multiples tend to soar as the market starts to discount better times ahead. So in September 2009, earnings troughed, but the PE was 20 times. And in 1992, when the PE hit a high of 19 times, it was only the start of a decade-long rally. In contrast, as earnings reach peak, the market discounts a weaker trajectory ahead, and the PE contracts. So without knowledge of where we are in the earnings cycle, the PE ratio becomes less useful as a concept. Further, the level of the PE is actually irrelevant for forecasting market returns over the next 12 months. In other words, the problem is there is no empirical evidence that the PE ratio has to be mean reverting. Even if we try to smooth the earnings cyclicality by using the so-called Shiller PE, which is price divided by 10-year average earnings, it tells us nothing of 1-year forward returns. Now, there's lots of different valuation models which you may come across. Tobin's Q, that's the ratio of a physical asset's market value and its replacement value. Market cap to GDP, the rule of 20, which is the S&P PE plus CPI should be equal to 20, but this simply reflects the negative correlation between inflation and multiples. The Fed model, which is the earnings yield less the 10-year treasury yield as a relative measure. Now, each of these models are different, but they all have common inflection points. They tend to peak and trough at the same time. The point is that macro is always the catalyst. If the conditions are right, the market can always become more cheap or expensive. Tracking the business cycle dynamics are key. So if we go back to the premise that the PE multiple reflects the balance between growth expectations and risk, namely financial conditions, let's look at how the PE looks against these basic concepts. On the left is the PE ratio against the so-called misery index, a simple proxy of consumer confidence and health. It's a sum of the unemployment rate and the inflation rate. When that is high, consumer misery is high. On the right is the PE ratio model against credit spreads, real rates, and the dollar, all major components of financial conditions. And both show a good relationship against the PE multiple, i.e. these are key drivers to watch. Now, we would pay close attention to labor market health. The unemployment rate is a lagging indicator in business cycle terms, but rarely have equities rallied when the unemployment rate is on the rise. According to the NFIB survey, hiring plans are falling, which portends badly for the unemployment rate. So we look to jobless claims to gauge labor market health. When they are rising, credit spreads also tend to rise, and we've overlaid these periods in blue. And rising jobless claims is synonymous with falling equities not rising. Here, the trough in jobless claims, more often than not, coincides with peaks in the equity market.